Strategists over at UBS are now saying that the Federal Reserve will cut interest rates by 275 basis points, nearly 4 times what the markets are pricing in. Bloomberg's Abigail Doolittle is here with the details. Abby?
Yeah, Matt, this is a pretty dramatic call. I mean, if you think about it, that's almost saying that rates will be 3% lower around this time next year than they are now. Now, the justification that UBS is using is they're saying that they see this as a normal rate cutting cycle ahead. So again, they expect 275 basis points by the end of next year. They think that we could start to see cuts as early as March. And then they're saying that one of the reasons inflation's down, I don't know that this is a justification, but they do see a recession starting by the second quarter of next year. So when I have thought about why would the Fed potentially cut sooner than the Fed is saying that they might cut if there was a recession around, that could be one reason. Now, when you put that 275 basis points against the market, which is basically at 75 basis points by the end of next December, it's a really wide divide. But the widest divide, Matt, might be markets and strategists versus the Fed itself, because the Fed on at least 2 occasions has said they're not cutting anytime soon. In fact, if we go into the Bloomberg terminal and we take a look at a chart that shows the 2-year yield and the 10-year yield, here's the 2-year yield. It's a weekly basis. You can see the uptrend is in place. The 10-year yield, the uptrend is in place. The 2-year yield very firmly from a number of technical chart perspectives, Matt, looks like it's going to continue to go higher. The 10-year yield, maybe a little bit less so, but if the 2-year yield does hold that uptrend, it would very firmly suggest that the Fed is less likely to cut. But again, we have lots of strategists right now talking about big cuts to Fed funds rate next year.